And now we cross over to our Woo-seung for global insight and an in-depth look at important developments in world affairs.
Thanks very much, Woo-kyun. It's time for Global Insight, where we connect with experts from around the world to hear their views on issues making headlines. After months and months of taper talks, the US Federal Reserve officials said Wednesday that the Fed would end its $120 billion bond buying program starting this month, reducing purchases of Treasury and mortgage-backed securities by $15 billion a month. And the scale of the cutback can be adjusted as needed. The Federal Open Market Committee said that it would start reducing its balance sheets as it was able to make substantial progress towards reaching maximum employment and seeing inflation averaging at around 2%. But now the question is when authorities will decide to raise the near-zero interest rates. And to discuss this today, we're joined by Jun-sok, Professor of Economics at the Catholic University of Korea. It's very lovely to see you again, Professor. How are you doing today?
Happy to be here.
Great, thank you for making time for us. And well, it was quite an early morning announcement for us, around 2 or 3 a.m., I believe. And well, the FOMC statement today about its tapering schedule, was it pretty much in line with what you were expecting about the pace and the scale of tapering?
I think the Fed had done a very good job in signaling exactly what they were going to do, and it did also take into account what the market was expecting as well. So there didn't seem to be any surprise in the financial markets. The Fed said that they will reduce their purchases by about 15 billion US dollars per month. And a lot of analysts have been mentioning that exact same amount week or even 2 weeks ago. So I think the announcement was right in line. And there, at least so far, there doesn't seem to be any disruption in the market. There doesn't seem to be any signs of taper tantrum that we've seen in the past. So the market has been expecting this. And the market may be even a bit glad because they've been worried about inflation.
Right, well, I think we can safely say now that the taper talks are all done and dusted, but now it's all about the interest rates, isn't it? What does the statement by the FOMC today really indicate about the timing of the rate hike?
Okay, well, they said that they would not raise the interest rate while the tapering is still in place, and because the tapering will take about 8 months to complete if they stick to this schedule that they've announced. The interest rate increase will probably not take place until at least 8 months from now when the tapering begins. And some analysts have been saying that perhaps the Fed will raise the rates during the first half of next year. That seems very unlikely at the moment. Now, the Fed has been mentioning that they have two goals. The inflation goal, which has been not met because inflation has been running higher than the Fed expected. So in that sense, the beginning of tapering, you can argue, is a bit overdue. But they've also said that they wanted to have maximum job creation. Right now, the job numbers in the United States, it's about 5 million jobs less than it was before the coronavirus. So at least in that sense, they have some ways to go. So this is, in a sense, somewhat splitting the difference. It's not raising the interest rate, but they are signaling that they want to control inflation. So they're probably going to wait until they see more job creation taking place, or if the inflation gets substantially worse than it is currently. But right now, I don't know if the inflation will get worse. If you look at month-to-month figures, it seems to be settling down a little bit, even though it's still at a high level. So interest rate, if it is going to rise, it's probably going to be at the second half of next year.
So you do see some risk to inflation worsening. I mean, given the supply chain bottlenecks and also many are worried about the pace of economic recovery as well. So with all of this in mind, I mean, when do you think would be the right time to start hiking those interest rates?
Okay, well, we're in a bit of an uncovered ground because, well, we never had a pandemic like this before, and we never had a monetary policy like this before. So they're going to be looking at data very closely. Right now, Fed is sort of betting the store on the fact that the inflation will go down. Right now, the reason that inflation is high is because of coronavirus causing some supply disruptions and the ports causing some bottlenecks in transportation. So the Fed expects that once coronavirus settles down a bit more, those bottlenecks and those production problems will cease and prices will go back to normal where it was in 2019 or so. If the Fed's expectations are correct, then we should see continuing lowering of inflation as the COVID situation recovers. But the big question here is what will be consumers' expectations? If the inflation runs longer than expected, people may raise their expectations of what the inflation is going to be, and that we haven't heard this word for a long time, wage price spiral, which will make inflation worse and even longer lasting. So what's really going to be important here is the length of inflation that we're going to have and how that affects consumer expectations, not only in the United States, but around the world.
Well, in Wednesday's statement, Fed officials did seem to acknowledge these concerns about inflation, and it said in its statement that sorry, let me read it for the exact quote. Yes, it said that inflation's been driven by transitory factors, and for months it's been saying that inflation is transitory. So you can see that it changed its wording there slightly. Do you think that the language was reassuring enough for traders?
Well, I think they're acknowledging what's going on, acknowledging the facts. The Fed has been saying that this will be transitory, and the way that they had mentioned it a few months ago was that at most it would last a month or two, but it's lasting longer than that already. And that may have caused the Fed, not only the Fed, but central banks around the world, some credibility because inflation has both been higher and longer than what they've been stating. So this is just, I think, acknowledging the facts as it is happening right now. And the question is how much higher and how much longer. Chairman Powell and U.S. Treasury Secretary Yellen has both stated that the inflation is now going to be longer than expected, and it's going to last until at least the beginnings of next year. If the month-to-month inflation falls, then I think the market will be reassured. But if the month-to-month inflation rises, then they may have some problem in maintaining their credibility.
And as well, normally a slowdown in economic growth is expected when rate hikes begin kicking in. And that's very worrying for the US economy, of course, because it hasn't fully recovered from this COVID-19 pandemic. So how do you expect the course of recovery to look? Do you think economic growth is going to slow down next year?
I think it'll for the United States, at least, they're having a fairly strong increase in spending. In August, the personal consumption expenditure rose by 1%. In September, it rose by 0.6%. One of the major reasons why the U.S. is having a bottleneck is because the imports of goods has risen because of the increased demand. I expect that to continue. This is the infamous revenge spending, pent-up spending that we've been hearing about, and that will probably continue for the near future. In the longer term, because the recession has been K-shaped and recovery has been K-shaped so that the richer part of the population has a lot of money, but the poorer part of population has some real problems. We don't know quite yet if the spending pace is going to continue, but then the United States right now has $1.5 trillion infrastructure plan and $1.5 to $1.175 trillion welfare and climate spending plan. We don't know if it's going to pass Congress, but if it does, that'll provide another boost to consumer and government spending, which should maintain relatively high rate of growth. But it'll have to pass Congress first, and we'll have to see whether the more richer part of the population spending wins out over the poorer part of the population's reduction in spending.
And well, before Wednesday's announcement was made, the Treasury's yield curve had been flattening for some time as short-term borrowing costs surged. How is the market now responding to the outcome of this policy meeting?
Okay, well, bond market, if you look at the Bloomberg Bond Aggregate Index, it's been showing that it will experience a loss this year. I think everybody expects that because of the high inflation as well as the expectation of lower tapering. But on the other hand, the stock market has been shrugging this off. They've reached record highs yesterday, even after the tapering announcement. And again, there doesn't seem to be any signs that we're having a taper tantrum. So everything seems to be not beyond what the market expected. So we will have some problems in short-term borrowing, but that's exactly why the Fed wants to do this. Too much short-term borrowing may have fed into the asset markets like the stock market and the housing market, which is experiencing such record highs. Some people, including myself, think that it's at least the beginning of a bubble, so they want to pop it as quickly as possible. So the difficulty in short-term borrowing is probably exactly what the Fed wants and what even some financial people want, because they don't want if there is a possibility of bubble, they really don't want to have it grow too much.
So while many traders seem to believe that Fed might introduce the rate hikes a bit earlier than expected, like even as early as June 2022, do you think these traders are getting ahead of themselves, or do you think they might be onto something?
Well, I expected personally that there might be a possibility that they will raise the rates at the first half of the year next year. But the Fed's position has always been that they will consider raising the interest rate only after the tapering has completely stopped. So unless the pace of the tapering accelerates, that rules out the first half of next year. Now, the Fed has opened itself to saying that we will decide on the pace of tapering depending on what they see in the economic data. So possibility that tapering will accelerate is there, but I think they'll try to stick to the schedule as much as possible. So if you're a betting man, and if you really want to bet, then the first rate rise is going to probably be the second half of next year.
Well, I don't know enough to bet, but maybe with your advice, I might do next time. But anyway, well, over here in South Korea, the central bank here has been also inching towards a rate hike as well after leaving it set at 0.75% last month. Can we expect the Bank of Korea to keep raising the key rate throughout 2022?
I think the case for Korea is, in a sense, even stronger because Korea didn't raise the interest rate necessarily because of inflation rate. The Bank of Korea raised its rates because of the household debt and corporate debt problem. The corporate debt and household debt has been rising very quickly, and it's among the highest in the OECD right now. So that's the main reason why they raised the interest rate. That has seemed to have slowed but not stopped the rise in the household debt. In fact, the beginning of the beginning of the interest rate rise may have accelerated some people's desire to get household debt, get the loans while the interest rate is still low. So I think in that sense, to maintain that goal, it is in South Korea and Bank of Korea's interest to raise the rates a few more times, one time perhaps at the end of this year, and one time at the beginning of next year. And then Korea's inflation rate has been increasing as well in the last couple of months. So that gives an additional reason why the Bank of Korea should raise its rates. Like the United States, the stock market and the real estate market has been rising very quickly. And that may also be a beginning of a bubble. So it's in the interest of the country and the Bank of Korea to pop that bubble. That means trying to raise the interest rate. When the coronavirus started, Korea reduced the interest rate by 1.25 percentage points. even if the Bank of Korea raises the rate 3 times, as I mentioned, that'll be 0.75 percentage points. So it'll be 0.5 percentage point less than when coronavirus started. So technically, we will have lower interest rate, even with the interest rate cut, than we had before the coronavirus.
Well, it does seem like inflation is everywhere, and we'll have to see how these policymakers plan to tackle it in the months to come, both in South Korea and the United States. And well, this is where we'll leave the discussion today. That was Professor Jun-sok at the Catholic University of Korea. Thank you so much for your time.
Thank you.